All right, we are going to look at an interesting topic here. Always generates a ton of interest around the subjects of non-direct and direct recognition, and specifically, we're talking about policy loans here. We're still in the policy loan series. So we've got direct recognition, but you'll notice to the left of it, it reads fixed. Specifically, I'm referring to a fixed loan interest rate, whereas non-direct recognition, we have a variable loan interest rate. Now, what I will note here is if an insurance company has a variable loan interest rate, that does not automatically mean that they practice non-direct recognition. There are companies out there, one specifically comes to mind that has a variable loan rate, but guess what? They practice direct recognition with their contracts. So I want to be aware of that. The example we're going to show you in this video is an insurance company that practices both non-direct and direct recognition. They actually give the policyholder the option when they first open a policy, hey, do you want to go with a fixed loan rate and have your contract be direct recognition? Or would you like a variable loan rate and have the policy be non-direct recognition? So let's get into it. With the fixed rate, we have a loan interest rate of 6%, and again, direct recognition. Variable, we've got 5%. The dividend rate with the insurance company we are going to demonstrate here is 6.2% for 2020. I probably gave away the insurance company to a couple of you here. So what we've got is a nice little chart here. Apples to apples scenario. Here's what's going to happen is if I have $100,000 in cash value, what that means is if I just let the money sit and grow, I don't touch it, that 6.2% dividend, I'm going to earn that on my money. If I don't touch the money in cash value, it doesn't matter if I go with non-direct or direct recognition. It has zero impact. When I loan it, that's where I will see the difference. So let's start with a non-direct recognition company. And it's kind of in the name here. A non-direct recognition company does not recognize that I take a loan out in respect to how they pay dividends and interest on my money. So if I were to loan out $50,000, so I've got $50,000 in cash value, I'm yielding the 6.2% dividend here, and I also loan $50,000 out. They are a non-direct recognition company, so they are going to continue to pay the exact same dividend on any money in cash value and what I loaned out. They collateralize the death benefit. We covered that in an earlier video. But what they're going to do is charge me loan interest, in this case at 5%. That again goes to the insurance company. Always want to be very clear when we talk about that. The loan interest on any policy goes to the insurance company, not back to ourselves. Now, with a direct recognition company, here's how this works. Is exact same dividend rate of 6.2%. I borrow out half of my cash value. The money still remaining in cash value receives a dividend of 6.2%. The unborrowed portion is not impacted at all. Now, I take a $50,000 loan out. 6% cost to borrow, again, goes to the insurance company. What happens here? The $50K that I loaned out, direct recognition. They directly recognize the fact that I take a loan from the life insurance policy. They still pay me a dividend. I'm still earning dividends on this entire bucket of money. This particular insurance company that we are referring to actually raises the dividend. You're going to find that it's over 6.5% on borrowed funds. How on earth and why on earth would they do that? And can you demonstrate that for me? That's what I asked. I'm like, okay, let me see it. Which they do that. We're going to look at a chart in an example here. But what I want to touch on here is here's a direct recognition company, or a company that offers direct recognition and non-direct recognition, where they actually raise the dividend rate on borrowed funds. What's so interesting about that is how many times have you done research, and I'd say probably about 80% of material out there states direct recognition is bad because they do not pay a dividend on borrowed funds or they reduce dividends on borrowed funds. Well, that's not true. A lot of our videos, we've used the term, it depends on the insurance company. Guess what? It depends on the insurance company. Direct recognition recognizes the fact that we take out a loan and they make an adjustment. I'll also add that I really don't think that it matters which one you go with, especially if you are using a quality company. So let's look at a nice flow chart here. Man, I love this stuff. That's why I'm doing this at 10:15 at night, but let's continue. So non-direct recognition. Growth example. We've got a payment of $50,000 for 5 years. Anytime we look at a loan scenario, kind of like our overview video, I love to show what it looks like if I just pay money in and let it sit and grow first and foremost. This way I can see what the actual impact is of the policy when I borrow and then repay, or maybe I don't repay. So here, paying in 50 for 5 years, exact same thing over here. This is similar to that overview video we looked at before. So as we look at this guy here, what do I want to look at? So this is our non-direct recognition study. Perfect. I've got my payments going in, 50 for 5, loan of $200,000. Just like our overview video, what happened when you borrowed? What happened to the death benefit? That's what's collateralized, meaning they're still going to pay me dividends and interest on my entire bucket of money. And they do that by collateralizing my death benefit. I will see a dollar for dollar reduction there. The cash value is the gauge that I can borrow. Refer to it in this manner, really as your line of credit. Simple way to simple terminology to use in my opinion. Now, in this example, we borrowed at $200,000 and then started to repay it at $20,000 per year. So non-direct recognition here. This specific example is non-direct. We are repaying it at $20K per year. We can repay it however we want. How do the dividends look compared to the example when I just let it sit and grow? They don't change. Non-direct recognition is way easier to understand of the two because nothing changes. If I let it sit and grow, or if I borrow and repay, if I repay, I'm going to see it 100% restored, the cash value and death benefit that is, to what it would have been as if I never touched it in the first place. I circled a year too early. 541 and 575. 541 and 1575. Fully restored when it's paid back to exactly what it would have been in the first place. Dividends have been the same all the way through, all that good stuff. Right, and that's good to be aware of. Again, this is not to say non-direct or direct recognition, one's better than each other, than the other, because it's not. Again, if we're using top tier quality companies, we use them both in our practice. Now, if we continue on, let's look at the direct recognition policy. Here's where it gets really interesting. Direct recognition, same thing, 50 for 5 years. Here's what I want to look at. Let's capture everything here. $200K loan. There's your death benefit reduction. Drops by about $200K. You'll see the loan interest is not $10K year one, it's $12K because it's a 6% rate on the direct recognition example. But here's really what I want to touch on. Look at the year that you borrow that $200,000 out. The year prior, it's $48.79. The year you loan, it's $68.04. So specifically what's happening here is I'm still receiving the basic 6.2% dividend on the money still in cash value and a higher dividend rate on my loan balance. Whereas over here, where I didn't touch it, it's to 6.2% dividend rate. So, same repayment amount. Here's what I'm interested in. Which one's higher? Interesting, isn't it? The reason why is these illustrations on the direct recognition example, the loan balance all the way through assumed a higher dividend crediting rate than what the standard dividend rate is. I know this can be a little complex, and we always want to assess different situations, different scenarios based on what we are trying to accomplish, but it's good information to have. You know, we often hear in the industry, oh, one option's bad, or just go with this one, and there's really not concrete data or reasons provided behind it other than the knowledge in an agent's head, which is good that an agent has that knowledge, but still, if we're the consumer, we want to see it. I wanted to see it, and that's why I drove people nuts at home offices when I asked for this stuff back in the day. But there we go. You see the direct recognition example is higher. What we also did here, and this is a little small, we just put non-direct side by side with direct. When it's paid back, if I just look at age 60, this might be small. 656 on the non-direct example. 683 in the direct recognition example. So 25,000, a little bit more additional in cash value in the direct recognition example makes it sound better, right? The thing is, if you were to tally up the loan payments, you've paid more over here because I've got a 6% cost to borrow over here and only a 5% cost to borrow over here. But then again, this is fixed, this is variable. To take it a step further, the contract language and the way you have to construct this policy is a little bit different than this one. It's the same company, but you give up some flexibility over here. Point being is the non-direct or direct recognition should not refine our decision-making process. The purpose of this video was really to show if I select a different loan interest rate, that's going to impact if the policy is non-direct or direct recognition, which does impact everything overall. So this one, as you can tell from me going a mile a minute here, I really enjoyed going through this topic, but as always, I hope this was helpful. Reach out with any questions, and we will talk to you on the next video. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.